finance and investment. In Africa, the hunt for capital can be tough. Let's face it, compared to 3 years ago, access to funding has been constrained. Since peaking at $772 billion in 2014, global capital raised shrank to a 5-year low of $531 billion in 2016. The 2014 crash reduced capital availability for oil and gas projects across every funding category. Bank debt is down significantly, with loans declining by 50%. Use of debt bonds has also declined, while private equity increased. Foreign institutions will continue to be the primary sources of capital for African energy projects. Local banking sectors are largely underdeveloped and lack lending capacity. Some have been overexposed. Nigerian banks, for example, lent $100 billion to local oil companies before the crash. Those loans are now liabilities, with 5 of Nigeria's largest banks issuing profit warnings in 2016. Limited cash and increased competition among companies has led to increased farm-in, farm-out and M&A activity as companies seek to optimize portfolios and increase cash flow, or capitalize on the downturn by purchasing undervalued assets. Tullow Oil, for example, is farming down its Lake Albert asset to Total for $900 million. BP is farming into Cosmos Energy's Mauritania and Senegal projects for $916 million. The value of Africa's upstream deals tripled to $4.6 billion last year. For companies emerging from the downturn with a damaged credit rating, funding will be hard to secure. They may turn to reserve-based lending. But as these loans are based on forward-looking cash flows, availability has shrunk. BNP Paribas announced in 2016 that it is pulling out of reserve-based loans altogether because of the default risk. Bonds can be a viable option for creditworthy borrowers. ExxonMobil raised $12 billion in 2016 from its largest ever bond sale, and syndicated loans are becoming especially popular as a means to disperse risk. Despite challenges, the need for investment has never been higher, with upstream projects demanding $92 billion annually in Africa. Power projects need $30 billion annually, and a host of players are stepping up. Export-import banks are providing continuous project finance backing. The EXIM Bank of the US has pledged $5 billion to Africa power projects. Development banks are also key. Nigeria's Azura Edo Independent Power Project has turned to 20 international banks and private equity partners to fund the $900 million project, including a boost from the World Bank. Competition for funding among both companies and countries is intense. Some countries are better positioned than others. Security, political stability, and well-managed privatization policies on a national level all convince financiers to dare to invest.